Strategies within hedge funds. Hedge funds are typically not directly comparable within categories, and even the categories that are widely utilized, for example, a CISA used for hedge funds, are not ideal for carving out a subset of hedge funds that are directly comparable. For example, two general equity funds are typically directly comparable as peers. However, two long-short equity hedge funds might not be comparable at all, as one might have a higher risk, higher volatility return profile, and another might have a more cautious upside return profile. There are three broad categories that hedge funds are classified into: equity strategies, fixed income strategies, and multi-asset strategies. Multi-asset strategies could include any combination of equity, fixed income, and commodities. Within the established classes, there are subclasses. As an example, within equity, we have long-short equity and market-neutral classes. Long-short equity is probably the most popular category that is available to investors. This is where a fund manager would be most comparable to a traditional equity fund, with the additional possibility of shorting. Long-short equity hedge funds are the most common type of hedge fund. They range from cautious to aggressive and do have directional market exposure. Market neutral funds within the equity hedge space are probably the most protected type of fund relative to market movements. Market neutral managers do not try to exploit directional movements in the market. However, they exploit the relative differences between their longs and their shorts to generate returns. Simply looking at the top line classification, equity, fixed income, multi-asset, is imperfect, as the funds within those categories are not necessarily comparable. Within those categories, we will often have low, moderate, and high risk or growth focused funds. Only once we have isolated for both overall strategy and risk can we really consider two funds that are within the same asset class and with the same risk profile comparable. Having said that, funds are still very divergent, and we do need to understand the underlying strategy for each individual fund to understand the possible use within an end investor's portfolio. To demonstrate the nuances in the risk spectrum within these categories, a simple example would be to look at a manager that wishes to express that they consider ShopRite to be a great business and Pick n Pay to be a poor business or an overvalued business. The riskiest way to express this view is simply to not own the Pick n Pay and invest 100% of your capital in the ShopRite. This would be a straight up long trade and would leave one 100% exposed to market movements. The cautious way to express this, and this is something we would find in a market neutral fund at the low end of the spectrum, would be to own the ShopRite but also short the Pick n Pay relative to the ShopRite, thereby cancelling out any market exposure but being exposed to the relative differences in the performances between those two shares. In between would be any combination of the above. The other way a long-short manager could perhaps express this view in a more risky fashion was not owning the ShopRite at all, but outright shorting the Pick n Pay, something we would consider quite risky and would edge us towards the higher end of that risk classification spectrum, where one has an inverse exposure to the market, but still a significant risk relative to market direction. Another nice example of a low-risk equity trade would be an announced and approved corporate action trade. As an example, Distell was acquired by Heineken. There was a period during which this trade was unconditional and approved, where one could acquire Distell at a discount relative to the price being paid by Heineken. This presented effectively a riskless profit to be made. A long-only manager, given its lack of flexibility, would typically not have been able to exploit this opportunity to the same extent as a hedge fund. A hedge fund could assume significant concentration in this position without affecting its other positions, whereas because a long-only manager has a limited amount of capital to allocate, it could not actually add alpha to the return series by significantly investing into this opportunity. Now, once again, these are the kinds of opportunities that can be exploited more efficiently by hedge funds through the use of derivatives that are not typically available to long-only fund managers. Within fixed income, the same applies. At the less risky end of the spectrum, we'll typically have low risk, high certainty, short duration instruments being held with a high degree of conviction. At the risky end of the spectrum, we might have significantly more duration. We might have significantly more credit. We might have fund managers taking forward rate agreement positions to take a bet on the direction of interest rates in the future. And of course, in the middle, we'll have the moderate investor, which will have a combination of the two. Within multi-strat, we of course have both equity and fixed income in the same way we have them in the other two classes, with the addition potentially of commodities. A lower risk commodity trade would be, again, a long-short trade, where we would, for example, go long a soybean future in Johannesburg and short a soybean future in Chicago. At the higher end of the spectrum, we may take a directional view and actually bet on the soybean future locally appreciating more without hedging it on the other side by going short it in a different market.